Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. As listeners know, I usually have a quick preamble before turning to our special guests, but I'll skip my usual pontificating, which probably would have been on Omicron, and turn right to our guest spotlights. And I should say guests because we have three important central bank meetings this coming week in the Bank of England, the ECB, and the Fed. And I have a panel of three of our experts here today to opine on this. So getting right into it, I'm going to start with Ross Walker, our chief UK economist, with what might be the more unpredictable of the meetings, which is the Bank of England. I'm going to ask all three of you the same question, but unfortunately, Ross, you don't get the chance to think about an answer like the other two because you're going first. So what do you expect for the meeting this coming week? And what do you think is the biggest risk for the meeting, or what would surprise you the most?
So in terms of expectations, we think the Bank of England will leave interest rates on hold in December, which was not our call and certainly not what the market was pricing until very recently. It's the asymmetry around the Omicron risks, we think, which ultimately will outweigh the fairly resilient post-furlough labour market data we've seen. So the surprise would be that in the face of these rising COVID concerns and some new restrictions on economic activity, that the BOE would nevertheless plough ahead and raise rates at this point, rather than waiting until the meeting in early February, when we'll probably be in a better position to assess just how much of a risk this poses.
And I will note that that is one of your calls from several months ago that came under pretty heavy pressure in the meantime. So nice job on that. So do you think that the messaging around this will be more of a dovish hold, a hawkish hold, or pretty neutral, thinking about where, kind of what the market's expecting at the moment?
I think a hawkish hold, or at least a conditional hawkish hold, a signal that rate rises are still likely, they're expected, but they will need to get through, the economy will need to get through what could be a tricky month or two through the winter, where at least certain sectors could again be under a bit more pressure. But I think fundamentally, the message in recent BOE policymakers' speeches has been that they remain confident about the recovery, that there is limited supply and price pressures have obviously overshot recent expectations, and therefore they believe there is a need to deliver some modest policy tightening over the course of next year.
Okay. All right. Thanks, Ross. Next up, we have Kevin Cummins, our chief U.S. economist. Kevin, same question. What do you expect for the meeting this coming week? And what do you think is the biggest risk for the meeting, or what would surprise you the most? Now, of course, it is a December meeting, so we also get the Fed Dodge. So if you don't mind touching on that, as far as their signaling goes through that would be great too.
Sure. Well, I think the most likely outcome that we're going to get, especially with Chair Powell kind of pre-announcing a faster taper just a few weeks back when he testified on November 30th, that the Fed is, that conditions in the overall economy suggest that they need to pull forward the taper. So I think that's the most likely outcome that we're going to get here. They want more flexibility given the uncertainty of inflation to react to that potential higher inflation risk that they see next year. So I think that's the base case as far as expecting out of this meeting. I think that the next thing, as you mentioned, is the dots. Back in September, they only showed one increase for next year. In our forecast, we think that they're going to pull forward another hike into 2022. Back in September, they showed 3 hikes in 23. So I think the big question is whether or not they stick with that and show 3 more, or they kind of compensate for pulling forward a hike into 22 and still show 4 hikes in total by the end of next year, which I think is their base case. I think they want to probably offset a little bit of the hawkishness in that the language on inflation in the statement is likely to be a little bit less certain as to far as whether inflation is going to come down. You'll probably see the charts on the risks around inflation pick up. So I think rather than really signaling a hawkish message, I think Powell and the rest of the FOMC would prefer to show that despite this increased uncertainty on inflation, the reaction function hasn't changed over the next year and a half or so. So I think they'll want to show 4 hikes in total, so 2 in 22 and 2 in 23. And then out to 24, I don't think the backdrop has changed enough that they'll probably show 3 more hikes then. So that's the general expectation going into the meeting. I think the biggest surprise would have to be that if they weren't going to accelerate the taper in December. But I think that's really highly unlikely. I think you heard a lot of Fed officials, even after Powell spoke in his recent testimony, on board with even some of the more dovish ones, on board with pulling faster taper and giving themselves more flexibility. I think the next surprise would be if they were to just leave the dot plot only showing 1 hike in 2022. I think they'd be criticized for kind of falling behind and not really worried about the inflation backdrop, which presents some real risk to whether or not they get back to their 2% target eventually.
So that sounds like almost like a dovish taper. Especially if they keep the terminal rate, so to speak, or the path of through policy through next year and 23 the same. The same time, basically kind of giving and taking away a little bit on the taper and then the rate hikes. Thanks, Kevin. All right, last but not least is Giovanni Zanni, our chief Euro area economist. Gio, same deal. Expectations, surprises, biggest risks?
Yes, well, first I would like to say that we had a lot of very confusing, communication from the ECB. So our title for our note, Angry Birds, is clearly what's happening there between dovish and hawkish members of the council. But anyway, so the expectations, the consensus expectation, our expectation as well, are that the PEP is expected to be terminated in March, and they will say so in quite clear ways. Also, the commitment to not hike rates in 2022 should be very explicitly stated by Lagarde. And finally, also the commitment to continue with QE even beyond the PEP, and actually to double the amount of APP from 20 billion to 40 billion at least, and for at least 6 months, and also to provide sufficient flexibility to deal with risk of fragmentation, financial instability. So that's, if you want, that's the kind of body of central expectations. Then if you ask me about the risks, I would say that there seems to be quite one-sided in different ways. The first one is that because of this inability to find a clear consensus, there will be an uncertain, confusing message delivered at the meeting. The other element of risk is the fact that the hawkish views can prevail. We've seen it in other central banks. It has been even more extreme. Now, maybe in the case of the Bank of England, they have to roll back a little bit, but in the case of the euro area, the move was still not complete. And so that will be the most likely direction in terms of risks. And finally, also on the inflation expectation with risks, if they said that the risks are on the upside. So these are all hawkish elements. So my surprise, if you want a kind of surprise, would be instead if they come out with a more dovish view related to Omicron or to the continuation of the PEP beyond March, because there's overall and in the end, they're not so sure about the end of the pandemic. But I would say that will be a surprise, yeah.
Yeah, I think for me, it's going to be interesting to see how Lagarde threads the needle of some of these different commentaries from different sections of hawks and doves, and how we come out the other end of that. So thanks, Gio. And thanks to all three of you for taking the time to join me ahead of what's going to be quite an eventful week before we start getting ready for the holidays. Just a little housekeeping before I sign off. There's going to be one more weekly watch to review some of these central bank meetings before we sign off for the year. So thank you, everyone, for listening, and I'll speak to you all next week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.